Here in this video, we are going to take a look at this article. Pretty interesting one. It says AMC stock was the top generator of revenue for lenders in 2023. Thanks to AMC's eventful share performance in 2023, lenders generated $500 million in revenue due to high demand to borrow the stock. Well, isn't that crazy? AMC stock was a popular target for short sellers and still remains to be that way. Besides that, we are going to take a brief look at the Ortex data, the stock tracker data, and take a look at what's going on in the broader markets. We did have our jobs report on Friday. We had your ISM numbers that came out, and people are starting to say those numbers really don't look that great. And it might show the economy is slowing down faster than what some people think. So let's get into this video, guys. Hit that like button and subscribe to the channel if you make it to the end of this video and you like the perspective that is provided here. So it says AMC stock was the top generator of revenue for lenders in 2023. It says AMC stock generated $511 million worth of revenue for securities lenders in 2023. That's almost half of the market cap of AMC. That's actually insane. It says, what is stock lending? I think you guys already know what stock lending is. It says, according to DataLend, AMC was the highest global revenue generator in 2023 for lenders. That's just crazy. The other securities comprising the top 5 revenue generators were SiriusXM, Beyond Meat, Lucid, and Nikola. Collectively, these securities contributed $1.1 billion to lenders throughout 2023, marking a significant increase from the $769 million generated by the top 5 earners in 2022. So cost to borrow fees were definitely on the high end in 2023, that's for sure. In the third quarter, Q3 of 2023, AMC outperformed the other largest revenue generators for lenders, Kenvue and SiriusXM being responsible for $157.2 million compared to $69.3 million and $63.2 million respectively. So AMC's revenues are also the highest here out of any of these other companies here. It says, why was AMC's lending revenue so high? A significant portion of these substantial revenue generated from AMC lending activity can be contributed to the company's eventful 2023. Throughout much of the year, AMC had both its common stock as well as preferred equity units. Both securities traded with a considerable spread between them. Arbitrage traders seized the opportunity, leading to an extraordinary demand for borrowing AMC shares. At certain times, the borrowing fees reached as high as 1,000%. The situation was further complicated by the company's initiative to convert the apes into common shares, a process marred by a class action lawsuit. AMC eventually received approval for the conversion. However, since then, shares have dropped by more than 80%. This decline has enabled short sellers to profit by repurchasing the borrowed shares at a lower price. Currently, the demand for borrowing AMC shares appears to have diminished, being less than 1% in recent days. This suggests that most short sellers closed their positions in the last quarter of the year. I don't think that's correct. I don't think short sellers close their positions in the last quarter of the year. I don't think they've ever closed their positions. I think they've used options, because options are now a lot cheaper than they were before, to maybe hide some of their short positions. But I think most hedge funds and institutions that are in this, into shorting AMC, they're looking at this and shorting the stock for the stock to ultimately go to zero and to go bankrupt. I think it's more egotistical trying to prove dumb money wrong than really even trying to make a profit for themselves. Now, here's something we talked about in the last video as well. It's the StockTwits sentiment and message volume gauge. Message volume is at 95, so it's extremely high. But your sentiment was at 0 on Friday. Today it's at 6. So if we can get sentiment higher, message volume to stay where it is, which I think message volume is most important. Sentiment changes day by day. But if we can get message volume to stay the same and sentiment to get extremely bullish, well, yeah, then we're potentially looking at a much larger rally that could be coming in AMC stock. Potentially shorts covering on short positions. All of that. Now let's take a look here at the Ortex data for AMC stock. Option activity on Friday was a lot better than the average for the last week. The average for the last week was 20% positive order value. On Friday, it was 49% positive order value. You've seen 3 orders totaling $304,000 with volume of 52.29% to the call side and 47.71% to the put side. If we take a look at the short interest data here, you do have 8.05% short interest of free float, $107 million worth of short positions, days to cover 0.98, 20.18 million shares that are currently sold short, shares out on loan 16.01 million, cost to borrow 1.08%, utilization of 29.99%, and a short score of 52.48 out of 100. Cost to borrow fees currently about 1.5% across the board, so nothing too exciting there. Stonko tracker data. So on Friday, we had about 77,000 calls expire out the money, 27,000 puts expire in the money, about 9,000 puts expire out the money, and 1,400 calls expire in the money. Now, for next week, it's not going to be a huge week for option activity. We'll see. You could have seen some rollover effect from last week's contracts to this upcoming week. Currently, you do have about 1,000 calls currently in the money, 40,000 calls out the money for this upcoming week, for the week of January 12th. On the put side, about 15,000 puts in the money and 10,000 puts out the money. For January 19th, that's going to be the next big week, and hopefully we get this announcement from Adam Aaron, in which I'm starting to anticipate that we will not see any further dilution for a period of time. Maybe it's all of 2024, maybe it's the first 2 quarters of 2024, aka the first half of 2024. Maybe it's not until the second half of 2024. Who knows? But I do think we will get that announcement, and that will stabilize AMC and start to allow AMC to actually start to rally. Now, let's take a look at kind of what's going on in the broader markets as well. So if you're looking at corporate bond yields, the spreads here, the lower the better. So but spreads have been falling. If you look at this yellow line is 10 and 2-year treasuries. If you look at the blue and the red, they continue to fall, which is a great thing. When you head into recessionary periods of time, these spreads will, widen a lot, and that is not good. Right now they are narrowing, so that's a pretty good sign actually that, big money investors, like bond investors, corporate bond investors, which is not you and me, it's big money. They are actually feeling okay about where things are at. Now, if you take a look at the data that we got on Friday, Wall Street is confused right now. That's really the bottom line. Everyone is confused about what the data means, what's good or what is bad. Is a weakening labor market good, or is that bad? What we got with the non-farm payrolls is 216,000 job ads. That was better than the expected 170,000 job ads. So markets looked at that and said labor market is running, hot. Labor market's doing well. But if you actually look at the certain sectors here, it says the U.S. economy added 216,000 jobs in December, more than the downwardly revised 173,000 in November, and well above market forecasts of 170,000. Employment continued to trend up in government. That was 52,000 job ads. Leisure hospitality, 40,000. Healthcare, 38,000. Social assistance, 21,000. And construction, 17,000. While transportation and warehousing lost jobs of 23,000. Yeah, so you're actually losing some pretty sizable amounts of jobs now in certain sectors. If you really take out government jobs here, the jobs report's going to look a lot worse. And that's what Wall Street, started to point out. Like, hey, that's not exactly great. The unemployment rate continued to stay at 3.7. Estimate was 3.8, so that was good as well. Better to see that low than high. But what a lot of people were concerned about was the ISM services PMI. This came in much lower than expectations. You're almost in contraction for services. Now, goods and services, that's really what controls this economy, right? Goods, well, it's been doing poorly for a while. Goods like discretionary products, TVs, stuff like that. Everyone went out to buy that stuff when they had all the extra money, right? When they were getting stimulus checks, stuff like that. So goods have really not been in a great place. Services have been doing very well. Now, what happens if services start to not do so well? What does that mean for the economy? Well, it's probably not a great thing. And that's what a lot of people started to kind of say. ISM Services PMI came in at 50.6. The estimate was 52.6. So anything under 50 is contractionary. You're pretty close to that. Now, specifically in some of this ISM data, you can see ISM Services business activity came in a little bit better than expected at 56.6. ISM Services employment just plummeted. Absolutely got wrecked at 43.3. This means that service companies are really not planning to hire people in the coming months, that they might actually be looking to fire people in the coming months. That's not exactly a great sign. I mean, if you look at this, I mean, this is kind of what we've seen. This was all of 2023. You were, I mean, in the 50s, right? Besides May of 2023, you hit 49.2. But this was a plummeting of employment via the ISM Services employment. Not exactly great. I think is the bottom line there. ISM new orders came in less than expected as well at 52.8. The estimate was 55.7. This is another low reading, but we've kind of been here before, so it's nothing kind of new. ISM services prices did come in lower again following just the last 6 months or so of slowly going lower for ISM service prices. We did have Fed Barkin as well. Really didn't say much compared to, what we already knew. So that wasn't really an event at all either. But there's a lot of people that are confused right now, whether, we're going into a recession, whether we're not, whether the Fed is going to cut 6 times or 3 times, or there's a lot of confusion here on Wall Street. And I think that is a problem, at least here in the near term. We want to get the CPI number coming out this week because that makes a big difference. If CPI is continuing to plummet, then maybe you don't have to worry as much about a weakening labor market. If inflation is, not, if inflation's kind of still being sticky and stubborn, then you need to see some more weakness in the labor market. So I think next week's going to be a huge week, not only just because you get CPI data, but you also get the start of earnings season, which that's another picture we need clarity on, because typically companies are a good leading indicator of what's going on in the economy, how consumers are doing, things of that nature. So as we get earnings, well, we'll start to get more clarity on how the economy is actually doing. Now, the AI Investor Sentiment Survey that we just got for January 3rd came in at 48.6% bulls, 27.9% neutral, and 23.5% bears. So, bears retreating a little bit. Not exactly great for anyone that wants to continue to see this rally do well. Now, Goldman Sachs says, quote, "We continue to expect 3 consecutive 25 basis point cuts in the Fed funds rate in March, May, and June on the back of lower core inflation, followed by quarterly cuts to a terminal rate of 3.25 to 3.5%. And then Carl Quintanilla, he is he's been on CNBC for 24, 25 years now. You know who this is. Capital Economics says the jobs print was not quite as good as it looks at first glance. Besides the negative revisions, the gain was once again concentrated in only a few non-cyclical sectors. The 33,000 decline in temporary jobs is also a concern. You can also now see via the 10-day advanced decline line that stocks are now oversold when they were just overbought a couple of days ago. So you've seen a wild flip here for stocks to start 2024. This is one of the worst starts to a year you have pretty much ever seen. So it's been a rough one. Let me know what you think about all of this down below in the comment section. In regards to AMC stock, AMC is very oversold at 24.74 for the RSI. I think some good news here would really serve AMC well. AMC stock would probably start to rally aggressively. I don't know when Adam Aron is going to announce that we will not see more dilution, give us that period of time of no dilution. But when that does happen, AMC stock will start to perform much better. I think Adam Aron should have already done this. He should have marked his calendar for the 1st of January, let's say, and gave us this commitment. It doesn't look like that's happening. It doesn't look like that did happen yet. So I'm still patiently as possible, waiting for that to happen. And when that does happen, I think AMC stock will rally big time. Definitely get off of these multi-year lows that we are sitting at right now. If you look at the MACD is also kind of just trading sideways, not doing a whole lot of anything. But if we don't get that commitment to not diluting shareholders, if stocks continue to fall, then I think AMC stock is probably going back into the $4 range. But if you can see, that announcement, then I think AMC stock will start to do very, very well. Hit the like button and subscribe to the channel. Let me know what you guys think about all of this information down below in the comment section. You guys have a great weekend, and I will see you in the next one.